Sunday, November 29th, 2020, Maneco 64, home of alternative economics and contrarian views. So it's very early. This morning, I decided to do a video about surviving the coming monetary disorder or mayhem, as Jim Sinclair and Peter Carlin talk about in their Pocketbook of Gold. I'm going to go through what they say about the significance and importance of having gold. Before I do that, I'm going to recommend another very good book, if you can find it. It was recommended by Jim Sinclair many years ago. And the reason he recommended was so that his followers on his blog, jsmindset.com, which I have been following for many, many years. He set up that blog in 2003, and I think I started following it in 2003 when I first got involved in gold, is the book called Our Crowd. So it was written and published in the 60s by Stephen Birmingham. It's about the great Jewish families of New York. So there you go, Our Crowd. And Jim Sinclair's father was called Bertram Seligman. He was one of Jesse Livermore's best friends. They were traders. I'm not sure why Jim Sinclair's surname isn't Seligman officially, but he is a Seligman. Once you read this book, you understand where he's coming from, what part of society he was born into, and why I think it's very interesting that we listen to what he has to say. It's a great story, Our Crowd. I highly recommend it. You can see here, I started reading it again. I read it quite a few years ago, but yeah, good story. Yes, I think it's more important than ever to talk about what's going on monetarily. This book was written in 2009, published in 2010. At the time, the gold price was just over $1,000 beginning of 2010. So we haven't had monetary mayhem like they're talking here in this book. But even if you had bought gold then, you'd be doing well. So that's the thing about gold. It's insurance. And even if it doesn't happen, the mayhem, it's still going to preserve the value of your savings, I would say. And I'm not trying to tell people to invest in gold. What I'm trying to tell them is after they've invested, after they've been able to save, after they've been able to live within their means, if they have spare savings, and by that I mean monetary savings, I don't mean investments in the stock market or anything else. I personally think it's wise to keep some of that in precious metals, physical gold and silver. You might want to keep some fiat currency, or what they call today cash, because technically cash really used to be specie, which is gold and silver coin. The what we call cash today, the bank notes or the Federal Reserve notes, they're actually promissory notes to the cash. So there's another change of terms there that they've done to confuse people. But yeah, so you might say, well, they advised us or were warning us 10 years ago and nothing's happened. But I truly think that what's happened in 2020 with everything that's going on has accelerated the process of this mayhem. And I have some personal experience of monetary mayhem or currency mayhem, having grown up, been born and grown up in Brazil, born in the mid 60s and lived there to probably the early 80s. Actually, mid to late 80s. Technically, I was living there before we moved from Brazil. I experienced two currency collapses in Brazil. So we had two different currencies while I was growing up. Probably had another one when I was a little boy, which I don't remember because I was too young, maybe 2 or 3. And life goes on. But if you're holding a lot of the local currency, your wealth will be severely affected. So what did people do in Brazil? Well, generally, people who had some savings and some wealth to protect, they had real estate property. A lot of them held dollars as well. Dollar was a good thing to have, and it still is, even though we know that the dollar is going the way of a third world currency, I would say. So when the dollar goes, all the fiat currencies go. And that's why gold and silver are important. That's why gold and silver haven't really been that important in Brazil, because we've had the protection from the dollar. But I would have said gold would have been even better for Brazilians, and silver. But be as it may, yes, we have to look at when the whole system goes, not just like the currency of an emerging market or third world country, right? So we're going to jump this morning to page 132 in this book. And I'm not sure how easy it is to get this book online. One of my viewers told me a few weeks ago that he was able to get it. He had to pay like $150 or so. So I don't think they're available anymore. I don't think Jim Sinclair and his blog are selling. They're out of public. They're not publishing it anymore. So you have to get it secondhand. You might be thinking, oh, are you not going to do your live stream tonight? I will. I just got up really early and I thought it would be good to talk about this. So preparation is the key to survival. And I'm not talking about prepping here. I'm talking about more of the financial aspect of surviving. So, and some people might say, oh, you can't eat gold or silver. Yes, but you can surely exchange it for things that you can eat when the collapse comes of the currency. To own gold is to be short currency. And by that, of course, he means any currency, not just the dollar, the pound, the euro, the Aussie dollar, Canadian dollar. To own gold is to vote with your feet where government is concerned. People need to anticipate inflation and invest accordingly. If you wait until it is tangible and in sight, it will be too late. Gold's asset base is small. Currently, less than 1% of global assets under management are held in the form of gold, and much of that is in paper form. Japan and China together may control 40% of global foreign exchange reserves, but only about 2% of them are in gold. The US holds 80% in gold and Europe 70%. If China and Japan sought to hold just 10% of their reserves in gold, they would have to buy more than double of the world's annual gold production. As it becomes clear that China, India, and others seek increased gold reserves, and I would add a lot of others since 2010, and Russia especially, and high gold reserve nations suspend sales and become net buyers as they are now, the pressure on gold builds. Central bank gold purchases led by India and China are long-term systemic purchasing programs. Yeah, they're not trading, and that's how you should think as well. Systemic, long-term systemic purchasing programs. That's what we should have. Yes, we do watch the price every day, and maybe we shouldn't, but that's what holding gold is. It's a long-term systemic purchasing program. So we should think like the central banks. We're told by Jim Sinclair, the original person who said that we should be our own central banks. Their nature will put a floor under the gold price. Alongside of this, the downward pressure on the dollar continues unabated. Inflation in the American economy is evident in the lower dollar, as inflation is a currency phenomenon. Inflation in the global economy is now evident as gold rises against every currency, and it has since 2010. I think versus the pound, We were way below 1,000, of course, around 700 we got to, or even lower. And you just have to look at some of my videos, and I'll put one of them in the cards above and one in the description about how all fiat currencies really are sinking, and especially versus gold. So here's what he says about the dollar index, what we should look for. And the dollar index right now is near the low of this year, just below 92. So he says, if the US dollar holds 72 on the dollar index, then there will be no hyperinflation, only standard inflation. So that's still quite a way from where we are right now, 92. We are just below 92, but we were above 100 earlier this year, so it can move. If the US dollar breaks 62 on the dollar index, there will be some hyperinflation. If the US dollar trades below 52, there will be the hyperinflation of the century. Well, that would mean also a drop, sharp drop versus the euro and some of the major currencies. Does that mean you should have those major currencies? I don't think so, because gold is going to go faster than those major currencies are going to go up versus the dollar. So they're going to go down as well. As Jim Sinclair says here, inflation in the global economy is now evident as gold rises against every currency. So don't be fooled into thinking that you'll be protected by having Swiss francs or euros or other currencies. You might want to have some of them. They will outperform the dollar, but the biggest outperformers are going to be gold and silver. That's my opinion, of course. But I think there's a good chance that that will happen. The US dollar is much different today than it has been in generations. So he gives you all the reasons why, and there are 11 of them. We'll start with number 1. It has the carry trade against it. I won't go over the carry trade. I've made videos about the carry trade. I'll put another one up in the cards. It has the wish of central banks to diversify against it. That's number 2. Number 3, it has economic factors against it. So that's the dollar. Number 4, it now faces the rise of Asia. He's right. Number 5, 1968 to 1980. Well, that was the big bull market that we had when Jim Sinclair made his fortune. He was called Mr. Gold. Was a dress rehearsal, that bull market, it says here, as far as gold and the US dollar are concerned today. So he's really looking long term here, and that's how we should be looking at it. It's not just a trade we make for a month or two. 6, today is not a dress rehearsal where gold and the US dollar is concerned. 7, a permanent change in the US dollar's international importance is in motion. Well, I think it's even more so today, not just economically, but geopolitically, politically, domestically, the stability of the United States, as we're witnessing right now. Number 8, a permanent change in gold's relationship to international reserves is in process. Yes, it's a slow process. I think still about almost 2/3 of foreign exchange reserves are held in dollars, but it has been dropping gradually, and it could accelerate. We noticed the Chinese have been unloading quite a lot of dollar reserves in the last 18 months. Number 9, a resurgence to the US dollar's position of the reserve currency of choice is not going to happen. Number 10, gold is not going to re-experience the first quarter of 1980 fall. Number 11, gold is going to re-enter both the qualified investment category as well as accepted, respected monetary asset categories. So we got the tier 1 that gold has been put into by the FSB. or the Bank for International Settlements, or the Basel III. So that's what he was talking about way before they did it. So let's continue. So now, yeah, those 11 points are made. So we'll continue here, as I said. In owning gold, the choice of vehicle remains critical. ETFs are dangerous. Physical gold is not. Mining shares, producers, and especially explorers have a higher risk profile than physical gold. When successful, they can often outperform gold itself, but they can also go to zero, which won't happen with physical gold. ETFs may also go to zero. So he's not trying to push physical gold or anything. You might say, oh, he's a seller of physical gold, he's a dealer. No, he's a chairman of a mining company as well. He's just giving you here his honest view on things. The popularity of gold ETFs remains concerning. The claims of physical backing simply do not ring true. It is simply illogical to assume that gold ETFs have all or even most of the gold they claim to have in bullion form. There simply isn't that much gold in the gold cash market. He should know. Jim Sinclair. Size like ETFs claim to hold only trades between central banks that report their holdings. Their holdings have not dropped enough to offset even a part of those positions. World production versus industry offtake simply deny ETFs these positions. The linchpin of the ETF world remains the Comex. Comex futures are edified by a contract which is supposed to be deliverable into physical gold. But that is gradually being called into question. Delivery, which should be easy and straightforward, is now being actively discouraged and made arduous. I've said many times, because I was a futures and options broker, my focus of business was more in the government bond futures, but we had one or two clients who like to trade gold and silver futures. And I was talking to one of our clients about taking delivery, and my boss said, oh, forget about it. We never do deliveries. So they discourage people from taking deliveries. And Jim Sinclair knows, because he used to run his own futures and options brokerage in the late 70s, early 80s. Brokerage houses are not making efforts on behalf of clients as they should. Many red herrings are thrown up. The common one is that if you take delivery from the Comex warehouse, gold will need to be assayed or tested at great cost before it will be taken back by them. So what? Gold bars can be sold all over the world without assay. Professionals do it all the time. Assay is not only unnecessary, it also is not expensive, especially with gold at $1,000 plus per ounce. Banks are increasingly saying similar things. They say that delivery is very expensive, but if you ask them exactly how expensive, they don't seem to readily know the answer or the procedure for delivery. They, like the Comex, are actively trying to discourage physical delivery. That's right. That's why you shouldn't deal with Comex or the banks. Unless, of course, you want to trade, be a day trader in gold. Yeah, then go ahead and deal with the futures on Comex. The Comex back office appears antiquated and unprepared for a surge in demand for physical delivery of its gold futures contract. While we've seen this year with the crisis that deliveries have increased astronomically, and we're going to get in December, the December contract is going to be delivered. Will be interesting to see, and that's the contract that has the most open interest, the most deliveries usually. We'll see what happens there. Equally concerning is that some people who are taking delivery from the Comex are receiving bars that are not the correct weight. They're actually slightly overweight. While this may be advantageous for the few who receive the bars, in terms of the exchange performing its duties, it is highly worrying. It gives the impression that gold bars in the Comex warehouse may not be sufficient in number and that they are being desperately sourced by the exchange outside of their vaults to meet delivery demands. We also have substantiated reports that serial numbers on bars delivered do not match the serial numbers of the receipts people have held. This could be incompetence. It could also support the previous assertion that the Comex warehouse does not have enough gold to meet delivery, and third-party sources are being drafted in to make good. He puts this in italics. It says, if physical delivery begins to become a serious problem at the Comex and they shut the delivery window, the contract will have been novated and gold will soar. Then ETFs will fail as the scramble for physical becomes manic. Such an event is likely to be preceded by an increase in Comex margins towards 100%, whereby it will become a de facto cash market and no longer a margin futures exchange. Look for increasing Comex margin requirements as a canary in the coal mine for physical delivery suspension and mass ETF collapse. Market lockups like this could become more common in the future and not just in gold. When the commercial paper market recently locked up, it essentially closed. It did the same thing this year, the commercial paper market. I think the Fed had to step in again. It ceased business. So there is already an example of markets de facto shutting down, although technically remaining open. 100% margin Comex could be an equal situation. Debt defaults in the form of SIVs may be a forthcoming example of what happens to markets overloaded with junk paper. Gold will continue to respond to these events as it already has. So there you go. Comex is not what it seems, nor are ETFs, especially the GLD ETF. I agree with Jim Sinclair and Peter Carlin that, when push comes to shove, they wouldn't have all that gold, physical gold that they claim to have. And even if you try to get delivery, you have to have millions of dollars worth of GLD. So you as a small investor or saver, for example, wouldn't be able to ask GLD to deliver like an ounce of gold to you. No way, they wouldn't do that. So the politics of gold. Let's continue here. This is almost towards the end of this book. Gold is a unique instrument in that it measures confidence in government. As such, it is highly political. When gold rises over the long run, political legitimacy and the ability of government to lead and manage is being called into question. Government, however, is not an actor in isolation. Government represents powerful interests. Government was supposed to represent citizenry, i.e. people. The transformation of the Western world from industrial to financial capitalism has hugely expanded the genre and power of the financier in politics. At some point, industrial power reached the conclusion there was more money to be made in finance than industry. Well, I can think of General Electric right there, the example, or GE. This has spawned an oversized, deregulated, and wholly unnecessary financial services industry. Well, yeah, I think that's the big bubble, the financial services industry. It has continued to grow, of course, but I think it's still nevertheless a huge bubble in which corporate shareholders were downgraded in importance and the individual financier was upgraded. While stock markets have performed poorly, individual remuneration for highly placed people working in the financial world has grown enormously. Corporate capitalism has been jettisoned in favor of sudden and massive payouts for select individuals that is based on destruction, deceit, and fraud. Is it any wonder the common stock of a nation, its currency, continues to fall in value? Government legislated spending and financial industry profit have been revealed to be twinned, not separate. The disastrous situation the West finds itself in is a result of the triumph of personal opportunism over responsibility. Government has been all too happy to assist in this. The financial services and banking industry have been revealed as places where clients are fleeced for the benefit of bankers and their bonuses. The client relationship has been changed into where the client is first transformed into a counterparty and then a victim. Nobody seems to care how much they rip off someone else. The ends, in this case, getting personally rich, justify any means. Greed in its purest practical sense may actually be revealed to be not so good. It is mercenary and designed to plunder. In fact, it is destructive. Societies cannot be built, let alone maintained, on a philosophical concept of personal greed above all other human elements. While honesty and responsibility are sacrificed, there must be something larger than individual reward. People must give a damn about each other, and that includes people in the abstract sense, people one does not personally know. Those who deride any form of altruism remain committed only to the perpetuation of an immoral status quo. Protestations that human nature is fixed are hollow. It is no such thing. So this, of course, as I said, written 10 years ago, and I think we're getting to a point where society is getting really, there's something wrong, right? We're seeing riots in Paris, protests in London, people burning things everywhere. Things are not stable in society. There's definitely very little trust in government right now. So let's finish off here. The truth is, increasingly, we as citizens, whether in Europe or the United States, regardless of political party, no longer have confidence in our governments, banking and financial institutions, accounting methodologies, or much else for that matter. FASB 56 comes to mind on the accounting, right? A lot of you know about FASB 56. If not, Google it. And Google Catherine Austin Fitts, FASB 56, and you see what I mean. This is the unfortunate reason that gold continues to rise. The United States is technically bankrupt. Most banks are insolvent, and all in power are attempting to hide the fact. We are all being perpetually lied to night and day by government, financial institutions, mass media, and the press. Almost all of the people and entities we trust for financial planning, political leadership, and investigative oversight have become mired in mediocrity, on the way to outright corruption and deceit. Every possible scam has been perpetuated. This is the world of the sociopath. Those who believe it has always been so are misinformed and do not study history. The level of corruption and deceit in a society is neither fixed nor constant. Personal private gain has only recently in the United States trumped all considerations of building a viable society. Government destruction of personal liberty is a sign of institutional security. Wow, there you go. That's very relevant today. This lowers confidence, which is why gold is trading higher. That is why it will continue to trade higher. The gold price is a monitor of the success of the rule of law in society. That is why its rise is no cause for celebration. Eventually, gold will be used to help restore confidence in a confidence-shattered financial and political system through its re-entry into the monetary system. This is its historic roll until that genuine confidence in our societies is restored. Gold will not end its move to higher heights. So there you go. I thought it was really relevant to read that passage in the book. So hopefully you might be able to find this book. It's a gem, I would say. It's really one worth having. A Pocketbook of Gold, a survival manual for monetary mayhem by James Sinclair and Peter Carlin. There you go. So I hope you have a good rest of the weekend. And I'll talk to you later during the live stream tonight, 9 p.m. London. So take care. Bye.